As of the latest market close on Monday, June 29, 2026 at 4 p.m. Eastern Time, Nokia stock closed at $13.03 per share on the New York Stock Exchange, marking a slight positive move of 0.15% from the previous session. While a fraction of a percent might look like standard noise to an outsider, what happened during the actual trading session tells a much deeper story. The stock experienced a major intraday decline, flushing all the way down to $12.16 before an aggressive wave of buying stepped in to rescue the price by the closing bell. This intraday price rejection at the $12 level is highly significant because it happened right after a punishing 7% sell-off on the previous Friday. Most retail traders looking at basic charting features on everyday investing sites assume this volatility is a sign of weakness, but institutional trackers show a completely different picture. Large block orders and high volume prints indicate that major funds are accumulating shares during these sharp dips. While the broad market remains hyper-focused on mega-cap winners like Nvidia stock, Apple stock, or Tesla stock, sophisticated players are looking for deep value elsewhere. This massive gap between public perception and actual institutional flow creates a fascinating backdrop for anybody engaged in self-investing. The common narrative surrounding this business is that it is a slow-growing legacy hardware provider trapped in the cyclical and expensive world of telecom infrastructure. The general expectation is that its upside is permanently capped because telecom carriers are cutting back on their network build-outs. When investors open their individual brokerage accounts or manage their holdings through modern automated systems like Schwab Intelligent Portfolios, they tend to look past telecom names entirely. They view these assets as cash traps with minimal growth potential. But the reality is completely upending these expectations. The hidden catalyst driving the underlying business is a profound structural transformation into cloud intelligence and automated software networks. For instance, management recently announced an extensive collaboration with Google Cloud to embed advanced Gemini intelligence models directly into their network assurance systems. This software can reduce network troubleshooting times by up to 80% for global operators. By deploying automated software agents that can detect anomalies and fix network errors without human intervention, the firm is transitioning from a basic hardware seller into a premium software infrastructure vendor. This is the exact type of high-margin business model that the market typically rewards with massive valuation expansions, yet the current share price does not reflect this shift at all. Recent trading sessions have highlighted how macro factors can create massive distortion in equity pricing. When a global technology sell-off occurred last week, triggered by sudden anxieties regarding high-tech valuations in Asian and American indices, this asset was dragged down purely by association. Algorithms and baskets of tech equities were dumped indiscriminately, creating an artificial decline that had nothing to do with corporate performance. Anyone utilizing an interactive broker's trading setup or tracking deep market order books could see that the selling pressure was mechanical rather than fundamental. The volume during this downturn spiked past 70 million shares, which is way above normal trends. This tells us that retail panic was met with institutional absorption. Smart Capital uses sophisticated interactive brokers' fee structures and professional execution platforms to accumulate shares when a high-quality asset is mispriced during a broader market rout. Investors who use a traditional Fidelity brokerage account or execute through the Robinhood app often miss these deep liquidity shifts because they only see the daily red percentage print on their screens. If you look closely at the fundamental data from the first quarter of this year, the company actually reported a massive earnings per share beat of over 30%, alongside gross margins expanding by over 300 basis points to 45.5%. This margin expansion is a direct result of their higher margin software and optical equipment gaining market share. To fully grasp where this business is heading, it helps to look at how modern retail platforms are seeing shifts in capital allocation. Millions of individuals utilizing the SoFi active investing platform or managing retirement funds through Fidelity Investments are looking for alternatives to overvalued technology names. When people explore online investing options, they are often bombarded with advice suggesting they stick exclusively to traditional growth funds or popular Fidelity ETFs. However, specialized networking companies are becoming the backbone of the entire data processing sector. The massive data complexes built by cloud giants require specialized optical transport networks to shift massive amounts of data between servers at lightning speeds. The firm's optical networking division has seen an explosion in orders from web-scale internet giants. Their order book for this segment is growing 3 times faster than their current revenue recognition rate. This massive buildup of backlog demand is a leading financial indicator that will likely show up in upcoming quarterly results, providing a strong fundamental buffer against any temporary slowdown in traditional cellular hardware sales. Anyone looking for genuine investment help needs to look past the surface-level noise of cyclical mobile infrastructure and focus on this rapid expansion into hyperscale data networks. Let us look briefly at what this enterprise actually does today, because its modern profile is vastly different from the mobile handset manufacturer that people remember from decades ago. Headquartered in Finland, the corporation operates across multiple distinct segments, including mobile networks, network infrastructure, cloud and network services, and a highly lucrative intellectual property licensing arm known as Technologies. This licensing business holds tens of thousands of essential patents related to cellular connectivity, multimedia, and advanced computing hardware. Every time a major smartphone manufacturer or connected vehicle producer ships a product, they frequently have to pay licensing fees to this corporation, generating pure, high-margin cash that requires virtually zero capital expenditure to maintain. This consistent stream of licensing revenue provides a solid financial floor that protects the balance sheet even during tough economic cycles. While many early-stage technology firms burn through capital and dilute their shareholders, this organization maintains an incredibly robust balance sheet with billions in net cash, allowing them to fund massive internal research projects and execute share-back programs that directly benefit long-term owners. This stability is why conservative capital wealth divisions, like those managing Fidelity mutual funds or building long-term retirement wealth through Fidelity IRAs, maintain significant core holdings in the company. The forward-looking technical setup presents an interesting challenge to the standard bearish views circulating on popular online investment forums. Some technical analysts have pointed out a head and shoulders pattern on the long-term chart, predicting that the stock could slide further toward its historical support lines. They use this pattern to justify short positions or avoid the stock entirely on platforms like the Robinhood trading platform. But this technical perspective completely ignores a series of major structural partnerships that have fundamentally altered the long-term cash flow projections of the business. In late 2025, NVIDIA announced a major direct partnership with the firm to co-develop advanced artificial intelligence telecom networks, with reports confirming that the semiconductor giant even took a strategic financial stake. Furthermore, the company has expanded its relationships with Amazon Web Services to host its autonomous network systems directly on the cloud. These are not small marketing agreements. They are deep, integrated technical partnerships designed to integrate telecommunications infrastructure with modern cloud computing architectures. Comment below how many shares of Nokia stock you currently hold in your portfolio and whether you think the market is completely mispricing these big tech partnerships. When you look at how individual retail accounts operate, someone using a basic intelligent portfolio system or buying Robinhood fractional shares might not notice these deep corporate alignments, but they represent a massive shift in how the company will generate revenue over the next 5 years. As we look out toward the remaining quarters of 2026, the tension between market expectations and corporate reality will center around several major upcoming catalysts. The next big test occurs on July 23rd, when the company is scheduled to release its second quarter financial results. Wall Street expectations are relatively muted, with analysts projecting modest revenue numbers due to broader macro headwinds in the telecom sector. This low bar creates a perfect setup for a massive upside surprise, especially if the high-margin cloud software divisions continue to outperform expectations. If the corporate results confirm that the software transition is accelerating, it could trigger a massive short squeeze and forced institutional buying. Large short positions have accumulated as traders tried to hedge their tech exposure during the recent global market volatility. If those short positions are forced to cover, the upward price momentum could be incredibly swift, catching many retail investors off guard. For anyone managing their own capital through a dedicated individual brokerage account or using tools like the SoFi Robo-Advisor,